Rates go up and now suddenly you're questioning buying a home because maybe it doesn't feel affordable anymore. If you're ready to start the process of buying a house but wanted to understand how to determine affordability, this video is for you. I'm gonna go over a 6-step process today designed to help you get ready for that. And at the end, I'm actually gonna sync up a video also on how to protect your credit when you go through the home buying process. Hey, it's Ray, Mortgage Maestro Group. We're gonna start off with one of the most important things, which is assessing your income and your budget. 2 things about this: what is the stability? And what do your future earnings look like? If you're in a field with variable earnings, such as commission and bonuses or RSUs, are you going to include that in your affordability exercise, or are you going to exclude it because you're going to put it towards investing or not want to rely on that for affordability of buying a house? As far as stability goes, what does that look like? That's probably one of the most critical things, right? We want to make sure that our income is stable to feel comfortable when buying a home. Then there's this good old-fashioned budgeting tools. These are great. YNAB, Good Budget, Every Dollar, Simplify, Empower. The list goes on and on. You can even go free and old school. Free, create a Google Doc, some simple formulas, done. Old school, Sallie Mae Budget Worksheet is an editable PDF, but it has categories we often overlook. One of the most important ones, saving for ourselves first. Make sure to do that in your budgeting regardless of what tool you use. They all have different strengths and weaknesses. Find the one that you can work with and work it. Number 2, consider your lifestyle and your future goals. Lifestyle should not be completely cratered to own a property. It should go in alignment with that. So, do you love to snowboard, hike, travel, go out to dinner, invest for earnings or financial independence like real estate investing? These should all be considered in your long-term goals and your lifestyle goals in buying a home. If someone else is buying with you, of course, that's a fun conversation to talk through. What does this look like for us? What does successful home ownership feel like and look like financially for affordability? Number 3, consider your down payment. How big, how small? You have to decide. Does the old school rule of 28% of earnings towards a payment apply in today's day and age with cost of housing? You have to determine your risk threshold. That's very important. As far as down payment goes, you might be surprised because remember, you're financing this money over 30 years. This is not a car loan. So a bigger down payment may not impact the payment as much as compared to the trade-off of what that money can do for you if it remains liquid. This is where consulting with a great lender is phenomenal because they can help you go through exercises to determine different payments based on different down payments. Number 4, do not forget about additional homeownership costs, property taxes, homeowners insurance, which will vary from condo to single family home, and within HOAs as well. If there is a mortgage insurance, do not forget to factor that in. There are different levels from FHA to conventional. From there, maintenance and upkeep, maybe 1 to 3%. But it does depend on the type of property. It depends on the age and condition of the property as well. But do factor something in for this. Number 5, if you're gonna get deep into it, calculate the debt to income ratio. Take those total debts from that budget worksheet, your gross earnings. So if that's a salary of $100,000, that's like $8,300 a month. Use that number. You can come up with your debt ratios. What is tolerable to a lender? Well, it depends on the loan program. Because I'm gonna tell you right now, FHA is different than conventional, is different than VA, then is different than USDA, is different than non-traditional financing, such as a bank statement loan. Talk to the lender. They can advise you what to anticipate there. Work closely at the hip with them in this part of the process. Mortgage calculator, number 6. You can take that information, look up some interest rates, take the barometer of the average interest rates that you see right now. The reason for that, unless you're under contract today, it might be a waste of energy other than getting a sense of what rates are doing. And then if rates were 6.75, maybe pop in 7 into that mortgage calculator for this affordability on the payment. And the reason I put you there is that it's always safer in the rain to walk under an umbrella for your budget than to shoot tight. Rates go up and now suddenly you're questioning buying a home because maybe it doesn't feel affordable anymore. So always create a sense of safety and security in that part of the process. Don't forget in those calculators to make sure it includes property taxes, homeowners insurance, mortgage insurance, and HOA dues. Pull some data from maybe Redfin in a property that's in a zip code that you're thinking about buying. So some realistic numbers for this part of the process. I really hope this has been beneficial to you. to get you going in that direction. And as I mentioned, putting that video up about protecting your credit, it's worth a watch. You might be shocked at how many times your phone will ring once your credit is pulled. Hope you found value. Talk to you soon.